Hi friends, welcome to my channel. And this topic covers introduction to advanced level. This topic covers introduction to advanced level. It contains 20 advanced texts and solutions. And this introduction is very important. Don't skip the introduction. If you understand the introduction or the basics of these topics, then it will be easy to solve any problem, any advanced problem within 5 minutes. It is just a matter of 5 minutes to solve any advanced text. So don't skip the introduction. Above all, subscribe our channel for more advanced problems and solutions. Valuation of goodwill is there. Holding company accounts. Introduction to accounting is there with 500 journal entries. So subscribe our channel for more topics on accounting. Good luck. Balance sheet. Every business starts with a balance sheet. Every business starts with a balance sheet and ends with a balance sheet. And this balance sheet contains a list of assets and liabilities. Assets, liabilities, capital. Assets, liabilities and capital. And these assets, liabilities and capital have default balances. Debit, credit and a big credit. And these assets may be non-current assets and current assets. Assets may be non-current assets and current assets. And liabilities may be non-current liabilities and current liabilities. And capital or net worth is always having credit. And it is always non-current item. In the course of business, the values of assets, liabilities and net worth changes. And this is due to various business transactions. And these business transactions, majority of them are operating business transactions. Operating business transactions. These non-current business assets and non-current liabilities transactions are very few. But in respect of current assets and current liabilities, these items are changing. These items are changing. But the values of current assets and current liabilities and this net worth changes every millisecond. Maybe in big business houses. Every second it may change. But these non-current assets, the changes are very few. Annually depreciation may be charged for purchase of additional fixed assets, redemption of liabilities, and these are only few transactions are there. But in respect of current assets and current liabilities, the transactions are changing, happening every second in a business. And these assets, liabilities, see, debit balance and credit balance. There is one more debit and one more credit, and they are called expenses. Expenses and incomes. And this is debit. And this is credit. And these expenses are set off against incomes, and a net credit is taken out. Net credit. And this net credit is taken to here. That is why this is a big credit. Big credit. And this is called profit. So all expenses result in a reduction in the net worth, and all incomes adding to the credit of net worth. And in a year, these expenses are set off against incomes, and net profit is taken out, and this net profit is carried to the balance sheet. And this constitute operating business transactions constitute almost 100% of any business. Almost 100%, because here transactions are very few. And these transactions are summarized and set off against expenses, set off against incomes, and net profit is taken out, and this net profit is carried to the balance sheet, and this is balance sheet. And this balance sheet contains non-current assets and current assets, non-current liabilities and current liabilities. And in funds flow statement, our subject matter is and this current assets total is called gross working capital. Gross working capital. And this current assets minus current liabilities, that is the subject matter of funds flow statement. Current assets minus current liabilities, current assets minus current liabilities is equal to working capital. And this working capital is the subject matter of funds flow statement. And here is a list of non-current assets, goodwill. Goodwill appearing in the balance sheet. It may be a purchased goodwill. Purchased goodwill. Then land, non-current, buildings, plant, furniture, long-term investments, patent rights, trademarks, and these are all non-current items, discount, preliminary expense, etc. This can be again categorized into goodwill, intangible. Intangible. And this also intangible. This also intangible. These are deferred expenditures. Deferred expenses. These are non-current assets. These non-current items, liabilities, long-term loans, debentures, etc., workmen profit sharing fund, provision for taxation may be taken as current or non-current. May be current or non-current. That is, two items are there. One is proposed dividend. And provision for tax. And these two may be taken as either non-current or current. We will discuss it later. And the next is non-current items, otherwise net worth. And this net worth. And this is called the net worth. This is non-current item. Then next coming funds flow statement. In fund flow statement, the subject matter is net working capital. In fund flow statement, funds means net working capital of a business. That is current assets minus current liabilities. These are some of the examples of current assets and current liabilities appearing in any balance sheet. Cash and bank is there, or marketable securities there, sundry debtors, bills receivable, these are all account receivable, then stock of goods. 2 periods, current items are there. And next one is current liabilities, accounts payable and other payables. And this current assets minus current liabilities is the working capital, that is net working capital. In fund flow statement, funds means net working capital. So net working capital of year 2000 is 1,02,000 minus this current liabilities is equal to 42,000. And in 2001, current liability, current asset is what? How much? 1,20,000. And current liabilities 85,000. So working capital in 2001 is 35,000. And working capital 42,000 in year 2000, and in year 2001 it is only 35,000. So the working capital has decreased, come down. And decrease in working capital is 7,000 rupees. And in funds flow statement, funds means net working capital, this. And funds flow statement means a statement which shows the change in working capital over a period. Flow means change. Funds flow statement means a statement which shows changes in working capital over a period. From 2000 to 2001, the working capital has been decreased by 7,000 rupees. And the statement which shows the change in working capital over a period. That statement is known as funds flow statement. It shows sources of funds and applications of funds. In that context, we can say funds flow statement is a statement which shows sources and applications of funds over a period, and which shows the net increase or decrease in working capital. It has a balancing effect. Sources are there, applications are there, and the difference is treated as either increase or decrease in working capital. And we will study that. How this working capital changes. Only 3 transactions we need to understand. How working capital changes. How working capital changes. Understand 3 transactions. There are 3 transactions. 3 transactions. Funds flow statement over. We will study one by one. What are those 3 transactions? Okay? Let us start. Understanding these transactions are very important in the preparation of funds flow statement. There are pure financial transactions affecting current sections only. These are purely financial transactions, where both the aspects are current items. Both the aspects are current items. Aspects means debit and credit. Example. Of the sundry debtors, 4,000 rupees has been collected. What is the entry? Bank debtor to sundry debtors. Both are current. Example. See, 1,20,000 is the total current assets. 4,000. It will become 50,000. And it will become again 1,20,000. This 4,000 received, sundry debtors reduced by 4,000, and cash at bank increased by 4,000. It makes no change in the funds flow, because there is no funds are flowing within the working capital segment. Cash paid to creditors. See, 42,000 is sundry creditors at the end of 2001. Here we are paying 2,000 to sundry creditors. What will happen? Here it will become 20,000. Total current asset 1,80,000. Here it will reduce to 40,000. Working capital remains the same, is equal to this minus this, 35,000. Earlier it was 35,000. So these are pure financial transactions and not appearing in the funds flow statement. And while preparing the funds flow statement, we need to prepare a schedule of changes in working capital. Schedule of changes. That is, current assets will be written like this and current liabilities here, and we take each item separately. The difference in each item separately and aggregated, and we will get a total decrease in working capital like this. So pure financial transactions, that is both the aspects are current item, does not have a place in the funds flow statement. And the second is transactions affecting non-current items only. Transactions affecting non-current items, transactions affecting non-current sections. These are purely exchange transactions. Example, issue of shares or debentures for consideration other than cash. We'll take one example. Here equity capital is 3 lakhs and here written 3,50,000. See, how much is the opening equity capital? 3 lakhs. How much is closing? 3,50,000. So 50,000 rupees equity capital has been increased. And if this 50,000 equity capital issued to a machinery vendor or purchasing another company, say for example, the company acquired assets of another company by issuing 5,000 equity shares of rupees 10 each at par, and the assets acquired are buildings 25,000 and plant and machinery 20,000. Here equity capital is non-current, capital non-current, plant non-current, and buildings non-current. Building also non-current. Where both the aspects are non-current, it makes no change in the funds. What is the entry for this? Planned debtor. How much? 20,000. Buildings debtor 25,000. To share capital 45,000. Sorry, 50,000. Here the difference is there, 5,000 rupees difference is there. That difference is called goodwill. The excess purchase consideration paid over assets acquired. So one more debit will come here, goodwill account debtor. Goodwill debtor. And these type of informations will be there in several questions. The company acquired assets of another company by issuing 5,000 equity shares of rupees 10 each at par. The assets acquired are buildings 25,000 and plant and machinery 20,000. Share capital issued is 50,000. So the difference, excess consideration paid, is treated as goodwill. You know that. The value of the business as a whole and the value of the net assets taken over, that is called goodwill. The excess purchase consideration paid over net assets acquired. So that will be debited to goodwill account. In those cases, the question will give 5,000 rupees, say goodwill appearing at the end of year 5,000 rupees. And this is an exchange transaction. However, these exchange transactions may be mentioned in the funds flow statement, both as a source and as well as an application. And it will be recorded as source, applications. Source is issue of shares 50,000. Here, purchase of land, purchase of buildings and payment of how much goodwill? 5,000. Building 25. And this is total 50,000. Total 50,000. And these are exchange transactions, and it may not result in the change in the working capital of any business, where both aspects are non-current. Issue of shares, share capital, non-current. Plant, fixed asset, non-current. Building, fixed asset, non-current. Goodwill, intangible fixed asset, non-current. So if both the aspects are current, never shown in the funds flow statement. And both the aspects are non-current, it never shown in the funds flow statement. And this is an exchange transaction. Similarly, come to the balance sheet. See here, 8% redeemable preference shares nil, and saying 4,50,000. Preference shares were redeemed by issuing equity shares of rupees 1,50,000. This is also an exchange transaction. Similarly, redemption of debentures. In exchange of debentures, redemption is done by issuing fresh equity shares. These are all exchange transactions and does not affect the working capital, but it will be shown in the funds flow statement, both as a source and application. But there are some exchange transactions which include a non-current asset and a current asset. See, we will take another example. We'll take another example. The company acquired another assets of another company by issuing 5,000 equity shares of rupees 10 each at par. That means 50,000 is the issue of shares. And the assets acquired are buildings worth rupees 25,000 and stock 20,000. And this element is a current item. And in this case, you need to show only buildings and goodwill. The remaining stock is already adjusted in the current item. Okay. What is the journal entry here? Buildings account debtor. How much it is? Buildings 25,000. Stock debtor. How much stock? 20,000. Then to share capital, how much? Share capital 50,000. And difference, what is that? Goodwill. And here, stock is a current account, current item. Current item. This buildings, goodwill and share capital are non-current item. And this will appear in the funds flow statement as application payment for goodwill 5,000, purchase of buildings, how much? 25,000. And the source here is issue of shares, issue of shares, 50,000. And this item, stock, is a current item. The remaining items will be shown in the funds flow statement. The stock is already included in the current item. Transactions affecting current and non-current items. These are the transactions which affect the working capital position of any firm. And these are the transactions which are showing in the funds flow statement, either as a source or application. The difference between source and application may be treated as either increase or decrease in working capital. Increase or decrease in working capital. This funds flow statement has a balancing effect. The transactions are redemption of long-term liability. What is the journal entry? Term loan or 8% debentures, whatever it is. It's a long-term liability. Term loan account debtor 2 lakhs to bank 2 lakhs. Bank is a current item, current asset. And this term loan is a non-current item. These are cross transactions. And these cross transactions are affecting the working capital position of a firm. So if in any question, preference shares are redeemed or term loan is redeemed, 8% debentures are redeemed, these are all treated as application of fund. This is application of fund. Payment. Current asset is credit. The next is issue of shares or debentures. What is the entry? Bank account debtor to share capital account or debentures account. Bank is a current item and this is a non-current item. This is current account and this is share capital is non-current account. Debentures also non-current. And these cross transactions are affecting the working capital position. Another example, purchase of fixed assets. What is the entry? Fixed assets debtor to bank. These transactions affecting working capital. Fixed asset is a non-current item and bank is a current item. Sale of fixed assets. What is the entry? Bank debtor to fixed assets account or assets disposal account. One is non-current and another is bank is current account. Is a source. Sale of fixed asset is a source. And these sources are shown on the source side of the funds flow statement and applications are shown on the application side. The difference between total sources for the period and total applications of the period will be treated as either increase in working capital or a decrease in working capital. Increase in working capital is an application of fund and decrease in working capital is a source of fund. application is more. That means from working capital, that much amount is applied towards payment. But there are several other transactions, major source of fund. In the introduction, we have discussed about a big credit. There we are going. See, assets, liabilities, capital or net worth. There are several business transactions, and these transactions affecting current assets only does not make a change in the working capital, current items. But some transactions affecting non-current assets, cross transactions, these transactions are very few. Redemption of long-term liability, issue of shares, these are all not regular business transactions. There are only few transactions in a year. But the major transaction is lying here, this credit. They are called operating business transactions. In these operating business transactions, working capital is affected by each and every transaction. Each and every transaction resulting in change in the working capital position of a firm. And there are numerous expenses and numerous incomes. The major source of income is sales. Major source of expenditure is cost of goods sold for a trading firm. So, in any business, 99.99% of the transactions constitute operating business transactions. And due to this operating business transactions, the working capital is changing to a great extent. And in these cases, purchase and sale of fixed assets or issue of new shares or debentures, these are all very few transactions. And there are several expenses and incomes. And each expenses will result in a decrease in the working capital of the business. So it is very difficult to write all these in the funds flow statement. Then we have to bring all the day books to the funds flow statement. So what we are doing at the end of the year, all the expenses are transferred to trading profit and loss account, and all the incomes are transferred to trading profit and loss account for statement of income, whatever we call. And from this trading profit and loss account, expenses are set off against the incomes, and a net amount is taken out. A net amount will be either net profit or a net loss. And this is a major source of any business. We will take one example. Expenses incurred and paid. What is the entry? Say rent is paid, 1,000 rupees. Rent account letter to bank. Say this bank is a current item. Current asset. End of the year, rent account is closed and transferred to P&L account. What is the entry? Profit and loss account letter to rent account. We can eliminate this rent account. Both are same. What is the entry? Profit and loss account letter to bank, 1,000 rupees. This profit and loss account is the net worth item. That is why I said every millisecond this net worth of any business is changing. depending upon the volume of transaction. And the working capital also will keep on changing. And these transactions are million transactions may be there. It's very difficult to show each item separately in the funds flow statement. So we will set off all the expenses and incomes of any year and taken out the net credit or debit. If there is a loss, it is called funds lost in operation. Funds lost in operation. If the rent is payable, what will be the entry? Rent account debtor to rent payable account. Any item, rent, salary, wages, any item. Wages account to wages payable account. And this expenses payable is a current liability. Current item is there. And this rent account is transferred to P&L account. Eliminating rent account, we will get profit and loss account debtor 500 to expenses payable account 500. It is a cross transaction. Current liability is a non-current item. Non-current. Take an income. The major income is sale of goods. What is the entry? Whether cash or credit, bank account debtor or sundry debtors account debtor 2000 to sales account. This sales is transferred to trading profit and loss account. The entry is sales debtor to trading profit and loss. Cancelling both sales account. What is the entry? Bank or sundry debtors. This is a current asset. Both are current assets. And this is non-current. So the net credit or net debit of the profit and loss account is transferred to the balance sheet every year. That is why balance sheet is important. What is left at the end of the period. Similarly, cost of goods sold, dividend received, any income or any expense. One will be a current item and the other will be a non-current item, which changes the working capital position. But in the profit and loss account, there are several items which does not make a change in the working capital. Example, depreciation written off. Depreciation. What is the journal entry for depreciation? Depreciation account debtor, say 2000 to fixed asset account. To fixed asset account. 2000. Or provision for depreciation account, whatever it is. If it is provision for depreciation account, to provision for depreciation account. Then at the end of the year, this depreciation will be transferred to profit and loss account. It is an adjusting entry. It is usually done at the end of each year. Profit and loss account 2000 to depreciation account. You can eliminate depreciation account. Correct? What is the net entry? Profit and loss account debtor to fixed asset account. Both are non-current. Non-current. That is why depreciation is called as a non-fund item. While calculating funds from operation, we have to add this depreciation written off to the operating profit, because there is no fund payment involved in depreciation written off on fixed assets. The net entry is profit and loss account debtor to fixed asset account. Both are non-current items. So depreciation written off, goodwill written off, another fixed asset. Patents written off, trademarks written off. So depreciation written off, goodwill written off, discount on issue of shares and debentures written off, fictitious asset written off, fictitious assets written off, deferred expenditures written off. These are all, both the aspects are non-current items. So if any amount is written off towards depreciation, goodwill, etc., should be added back to the operating profit to find out funds from operation. Funds from operation. We need to calculate funds from operation. So we need to calculate funds from operation. How do we calculate funds from operation? After that, we will solve some questions. Okay. Another good example, loss on sale of fixed assets. What is the entry for loss on sale of fixed asset? Fixed assets book value 5,000 rupees, sold for 4,500 rupees. What is the entry? Bank debtor 4,500 to fixed asset account 4,500. This is the cash received on account of sale. What is the entry for loss? Loss on sale of fixed asset account debtor 500 to fixed asset account 500. We can combine this entry. Here one is a current item, so it is a cross transaction. Source of fund. But here this fixed asset is non-current, and this loss is transferred to P&L account. This loss on sale of fixed asset is cancelled. What is the entry? Profit and loss account debtor to fixed asset account. Both are non-current items. So if there is any loss on sale of fixed asset, that also should be, which is debited in the profit and loss account, should be added back to the operating profit to find out funds from operation. Okay. So how do we calculate funds from operation? Very simple. If we start with the profit and loss account balance, net operating profit as per profit and loss account, you write it here. Add non-fund and non-operating expenses and losses should be added back. We already discussed why. Depreciation, goodwill, preliminary expense, any other fictitious items written off, loss on sale of non-current assets written off, fixed assets. So these are all items should be added back. Less non-operating incomes, profit on sale of fixed assets, dividends received from long-term investments, because long-term investments are long-term non-current item. So if any dividend is received it should be shown as a separate source. Separate source. Got it? We will get the funds from operation. Sometimes we have to start this procedure from the balance sheet item. From the balance sheet. In those cases, we have to prepare an adjusted profit and loss account like this. This opening balance as per balance sheet should be shown on the credit side because profit is having credit balance. By opening balance to closing balance. Write it here. Then provision for taxation. Closing amount you can write it here. If provision for taxation treated as a non-current item. Provision made during the year. Provision made during the year should be shown. If it is treated as a current item, should not be shown here. Only if treated as non-current. Then proposed dividend, closing, if it is treated as a non-current item. But dividend paid will be there. Dividend paid always will be shown here. Interim dividend or a dividend paid, showing as an additional information. That should always be shown in the adjusted profit and loss account. If we are taking this profit from balance sheet, opening balance from balance sheet. Opening balance should be shown on the credit side, closing balance as on the debit side. Items to be added should be debited and items to be deducted should be credited. The difference will be funds from operation. And this will be funds from operation. It should be added and balance will be added. And this is adjusted profit and loss. Here important point is provision for taxation and proposed dividend will be shown in the adjusted P&L account only if it is treated as non-current. If it is included in the schedule of changes in working capital, it should not be shown here. This item should be eliminated. The remaining items should be taken off. Transfer to reserve, depreciation, non-operating loss, loss on sale of fixed assets, etc. Intangibles written off. And the balancing figure will be funds from operation, balancing, shown as a source. And this is the major source of any business. We can solve one example. Again, we are doing all these things. Okay? First, we will solve 2-3 simple questions. Then go for advanced topics. First, we have to familiar with the schedule of changes in working capital, how to calculate funds from operation, and what funds flow statement. Okay? So whenever a question like this, first divide the items between current and non-current items. Current and non-current items. And identify the changes. All the current items will be taken directly to the schedule of changes in working capital. And the changes in non-current items will be shown as either source or application of funds in the funds flow statement. Current items are taken directly to the schedule of changes. First, 7% redeemable preference shares, year 2000 nil. 2001, 10,000. No additional information. So assumed 7% redeemable preference shares has been issued during the year. This is end of year 2000, 31st March 2000. And this is 31st March 2001. In 2000, redeemable preference shares were not there. Now it has 10,000 rupees preference shares. So issue of shares, that is a source. Okay. Then equity shares, same amount, no change. General reserve, opening 2000, closing 2000, no change. If change is there, that may be amount transferred from profit and loss appropriation account to general reserve account. This amount is showing 3000, then we can say that 1000 has been transferred from the profit and loss appropriation account. And profit and loss for the year ended 2000 is 1000 rupees and closing 1200. Balance sheet profit and loss account is given. We need to prepare an adjusted profit and loss account. Debentures, long-term liability. Earlier 6,000, now 7,000, increased. So issue of debentures, it is a source. So in the funds flow statement, both preference and debentures will be shown as a source of fund. Issue of redeemable preference shares, issue of debentures, 1,000 rupees. Here 10,000. Then current liabilities, creditors, provision for taxation, proposed dividend and bank overdraft. These two items always provision for taxation, very important. If provision made during the year or tax paid is shown as an additional information, always provision for taxation should be treated as non-current item. Prepare necessary ledger account and find out the missing figure. Now we can assume that provision for taxation and proposed dividends are current items. The facts should be mentioned in the answer. Assumed provision for taxation and proposed dividends are treated as current item. Then bank overdraft 12,500, 6,800. These are all current liabilities, and these are taken directly to the schedule of changes in working capital. Then come to fixed assets. See, fixed assets opening 41,000, closing 40,000. This is original cost. Less depreciation, it means provision for depreciation account. Less depreciation, 11,000, 15,000. When fixed assets are shown at cost less provision for depreciation, always and better to make fixed assets ledger account and provision for depreciation account. Very important. Very, very important. It may be shown in different ways. Don't think everything will give directly. Indirect ways they will give. For example, this is one balance sheet, only asset item. Asset side, fixed assets given, net 5,10,000 opening, closing 6,20,000. Additional information, provision for depreciation stood at 1,50,000 and 1,90,000 rupees on 31st March and 31st March 2000 and 2001 respectively. This is one way. Another way is fixed assets at cost will be given like this. Less provision for depreciation and net figure is shown. How much? 41,000 original cost, less provision for depreciation, net figure is given here. It may be given like this also. Provision for depreciation may be shown on the liability side. Fixed assets at cost is shown on the asset side. Three different ways, three or more ways it may be shown. So very careful. In these cases, when provision for depreciation account is given, better you prepare provision for depreciation account and fixed asset account separately. Here fixed assets are given as a block. Fixed assets, which may include land and buildings, planned separately. So in those cases, we have to prepare necessary ledger accounts. And here original cost has been decreased by 1,000 rupees. And provision for depreciation increased by 3,000 rupees. So without writing ledger also, we can ascertain how much depreciation has been provided, 3,000. This depreciation 3,000 should be added to the or debited to the adjusted P&L account or added to the profit as the case may be. Then current assets given directly, and these current assets and current liabilities taken directly to the schedule of changes in working capital. It may appear like this. See, debtors, first we write current assets, debtors, stock, prepaid expense, cash, etc. All current assets should be written like this. Then current liabilities, creditors, provision for taxation, proposed dividends. So provision for taxation, proposed dividends are treated as current item. So no further adjustment required in the profit and loss adjustment account. Bank overdraft given. Then we have to find out the increase or decrease in each item. What is the effect of increase or decrease in the working capital, not the increase or decrease directly. When current asset increases, working capital increases. Or when current assets are increasing, it is debited. So increase here means a debit in respect of current assets. Assets increasing, debited. Asset decreasing, credited. In the case of liability, reverse is the case. Creditors are debited when decreases. Creditors are credited when increases. Otherwise, when current liability increases, it decreases working capital. When current liability increases, where we will show credit. Decreases. We will write each item. 20,000, 24,000. Increases working capital. So 4,000 will be written like this. Stock how much? Stock is 30,000 and 35,000 is mistake. Okay. So increase is 5,000. Here it is 200. Current asset increases, working capital increases. Cash how much increased? 3,500 minus 1,200, that is 2,300. Then come to current liabilities. When current liability increases, which working capital decreases, reverse order. Or when current liability increases, credited. When current liability decreases, debited. But both are same. We are accountants, no? Follow this debit credit rule. Creditors 12,000 beginning, 11,000 closing. Here creditors are decreasing. When current liability decreases, which increases working capital. Or when current liability decreases, we will give debit. Provision for taxation, that increases 1,200. When current liability increases, working capital decreases. Proposed dividend is increasing. So current liability increases, working capital decreases. Or when current liability increases, we will give credit. Okay. Then here bank overdraft decreasing. How much? 5,700. Correct? 5,000. Then we have to add all the current liabilities and current assets like this. Total A, total B, working capital A minus B. 51,500 minus 32,500. 19,000. 63,000 minus 27,800, 35,200. So there is increase in working capital is equal to this minus 16,000. The same difference will be here. Okay. Okay. 18,200 rupees in the total increase fund of 2,000. Working capital increase how much? 16,000. 18,200. And here assumption is that provision for taxation and proposed dividend are treated as current liability. This note should be appended to your answer. Very important. If provision for taxation is non-current item, working capital also will change. See, it will change. So, provision for taxation and the proposed dividend treatments are very important. If you are treating these items as current items, append a note like this always. Otherwise, you will lose the mark. 8. If it is non-current, what will be the effect in net working capital? This proposed dividend 5,000 is treated as a application. Assumed this 5,000 has been paid during the year. So application side is 5,000. And this 5,800 then debited to adjusted P&L account. So 5,800 will come here. Source. Source is 5,800 and application is 5,000. That increases working capital, 800 rupees. This is source, this is application. It is a source because it is added to the funds from operation, profit and loss adjustment account. Same as the case of provision for taxation. This 3,000 assumed it to has paid during the year. So opening provision for taxation assumed paid during the year. So 3,000 will come here and 4,200 will come here. Either case, two differences we take, 2,000 rupees difference will come. Provision for taxation, 3,000 is shown as an application. Assumed this has been paid, 3,000. And this 4,200 will be shown as source because it is added to the funds from operation. So 5,800 plus 4,200 how much? 10,000. 10,000 source comes. Only 8,000 application. Increase in working capital, how much? 2000. The same 2000 comes here. Okay? So this is the assumption. If you are treating provision for taxation and proposed dividends are treated as current liabilities, a note should be appended to your answer. Otherwise, the figure will change. Working capital increase or decrease will change. If this is treated as non-current, then that much difference will be there. 17,000. Then after completing the schedule of changes in working capital and the net decrease or increase, then we need to prepare necessary ledger accounts. If provision for depreciation account is given, always prepare provision for depreciation account and a fixed asset account at cost. Then fixed asset account should be at cost. So fixed asset opening 41,000, closing 40,000. So this information is there. It should be shown in the ledger account. Assets account have debit balance and to opening balance or to balance brought forward, brought down. Fixed assets 41,000 to opening balance. By closing balance 40,000. Then provision for depreciation account having credit balance. By opening balance to closing balance. And no other adjustment. No other information, not adjustment. So we can check it. Fixed asset account debit balance to opening balance by closing balance. Then no other information. 41,000, higher side is total 41,000. This 1,000 rupees is treated as, because of lack of information, treated as sale of fixed asset, assumed there is no profit or loss on sale of fixed asset. Provision for depreciation account, opening balance 11,000, closing balance 15,000. So balancing figure is how much? 4,000 rupees will fall. This is the depreciation provided during the year added to funds from operation or debited in the adjusted P&L account. So we have finished the schedule of changes in working capital, necessary ledger accounts, and dig out hidden informations. That is over. Then the next step is funds from operation. Funds from operation, we are taking the balances from the balance sheet. So better prepare adjusted P&L account. How to prepare adjusted P&L account? This profit and loss account balance opening will be shown on the credit side because all profits have credit to balance by balance brought down. And the closing balance will be shown on the debit side as to balance carry forward to balance sheet. So after completing that, check out general reserve. General reserve opening 2,000, closing 2,000. Assumed nothing has been transferred during the year. So that is over. Then provision for taxation and proposed dividends are treated as current item. So nothing to be done in the funds from operation. Then other item, only item pending here is depreciation for the year. Depreciation for the year is non-fund item, which is 4,000 rupees. And this item should be appeared in the adjusted P&L account. Opening balance, closing balance. Only one item is there to depreciation. Depreciation is 4,000. If transfer to reserve is there, we have to write here transfer to reserve. Then loss on sale, profit on sale, everything should be adjusted here. Then higher side should be balanced. 5,000 should be shown. This is by funds from operation. In bracket balancing. How much it is? 4,000. And this is shown as a source of fund in the funds flow statement. So we have completed schedule of changes in working capital and found that 16,200 working capital has been increased. And it should be corroborated by preparing another statement called funds flow statement. The sources are to be recorded first. First is funds from operation. We have calculated that is 4,200. 4,200 funds from operation. And the preference shares issued 10,000. Debentures 1,000. Then sale of fixed asset is there. Sale of fixed asset how much? 1,000. Total how much? 16,000. We need to prepare a funds flow statement. How to prepare funds flow statement? Funds flow statement of so and so company, like that. Here sources and here applications. The major source will be always funds from operation. How much it is? We calculated that. 4,200. 4,200. Then issue of redeemable preference shares. Issue of redeemable preference shares. How much? 10,000. Then issue of debentures are there. Issue of debentures. If you are noting it down like this, it is very easy to prepare funds flow statement. How much it is? Debentures 1,000 rupees. Then one more item is there that we have computed, 1,000 rupees. There is no profit or sale on fixed assets assumed. Because lack of information, we can assume only like that. What is that? Sale of fixed assets. How much? 1,000. Any applications here? Nothing. Provision for taxation, proposed dividend are treated as current item. So, not to be considered in the adjusted P&L account as well as in the funds flow statement. All the current items are taken to the schedule of changes in working capital. Then no further adjustment is required in sources and application of fund. So here total is how much? 16,000. 16,000. Here the balancing figure will be increase or decrease in working capital. Here where the balance comes, application. That is why increase in working capital is always treated as what? Application of increase in working capital. Balancing. The important point here is always write your assumptions and always it forms a part of your answer. If provision for taxation is treated as non-current, then this balancing figure will change. Very important. So schedule of changes in working capital, difference is increase in working capital 16,200. In the funds flow statement also the same 16,200. So one simple problem, it is over. You write down everything while viewing online. Don't view this accounting like a movie. Okay? Then we will come up with some advanced problems after doing one more question. Okay? Let us see. So this is a very good question. But dividend, assets of another company were purchased, etc., etc. And we have 19 other problems. 19 other 19 other text. 19 other text. In the second part. In the second part. So subscribe our channel and subscribe our channel for more text and solutions, advanced text and solutions. And we have uploading topics of valuation of goodwill, holding company accounts, nagging company accounts, electricity company accounts, etc. very soon. So subscribe our channel for more text and solutions, advanced text and solutions. And thank